I'm Grant Walker. Welcome to Last Call for Wednesday, the 8th of July. I'll be back with a heads up Thursday, 10 a.m. To China, and their share market plunge continues with the main stock exchange down a further 1.3% and dragging Hong Kong down with it. The drop is despite a range of moves by Chinese authorities to stem the slide and restore market confidence. The Shanghai Composite fell 1.3% on Tuesday, putting it down 27.9% from its peak in mid-June. Chinese authorities have set 4,500 as a target and have lent money to share brokers to achieve it. Other measures aimed at boosting shares include suspension of IPOs, lifting quotas for foreign investors and providing funds for buyers. China's smaller Shenzhen stock market fell for the second straight day, putting it down 5.3% for the week, while the Chinext board, composed of smaller cap stocks, dropped 11.2%. Both indices are off more than a third from June highs. Hong Kong's market also sank, with the Hang Seng Index falling 1% and a gauge of Chinese companies listed offshore in the city, known as H-shares, falling 3.3%. This fall in H-shares of more than 20% compared with highs reached in May. Investor losses since the slide began 3 weeks ago have reached an estimated $2.4 trillion. The Chinese market is dominated by private investors, many of whom have borrowed heavily to buy shares. Margin calls on these loans have fueled the collapse in small-cap shares as investors liquidate their holdings, and this hinders efforts to persuade buyers into the market. Companies are reacting by suspending their shares, 514 stocks in Shenzhen and 162 in Shanghai. Despite the rout, Shanghai shares are up 81% over the past year and 15.2% since January. World markets are feeling the effects in commodity prices. Oil plunged the most in a day on Monday in more than 3 months, though this was moderated on Tuesday, with Brent crude gaining 1.6% to US $57.43 a barrel. To the government's accounts, the government might pull off a budget surplus this year after all. The latest government financial statements released this morning show a $1.2 billion surplus for the 11 months to May. Total government revenue was $87 billion and expenses $85.5 billion. The tax take was up on forecasts, with the biggest single factor being a $378 million surge in corporate tax. Total tax revenue is $384 million ahead of forecast. Other increases come from other individuals' tax, mostly better performing revenue from taxation on investment income. The final figures for the year to June will be released in mid-October. National promised a budget surplus for the financial year to June 2015 at the 2014 election, but revised forecasts from the Treasury first in December and then in the budget delivered in May saw that expectation postponed until next year. Finance Minister Bill English, in delivering Budget 2015, expressed scepticism that the accounts could be turned around. The operating balance, which includes unrealised movements in the Crown's investment portfolios, was a surplus of $4.6 billion, well above the forecast surplus of $89 million, and up from a surplus of $4.33 billion a year earlier. The operating balance was bolstered by smaller actuarial losses on the Accident Compensation Corp's claims liability due to higher interest rates. The Crown accounts released this morning show ACC's insurance liability was $32.68 billion as at May 31, $2.74 billion smaller than forecast, while the Earthquake Commission's property damage liability was valued at $3.24 billion, $724 million more than expected. Net debt was $60.37 billion, or 25.3% of GDP, $164 million below forecast, while gross debt at $85.72 billion, or 35.9%, was $1.64 billion above expectations. The Crown's residual cash deficit was smaller than expected at $1.29 billion, with capital payments coming in under expectations, and was an improvement on the $3.83 billion shortfall a year earlier.
NBR Radio, Wednesday the 8th of July, and with me, Chris Keel. Chris, another US pay TV channel goes direct over the internet following HBO's lead. This time it's Showtime. Did you have any problems signing up?
I had a friend who had no issues at all signing up this morning to this $11 a month service. So it lets you watch Showtime shows. They've got a few marquee series like Homeland through your Apple TV on your regular TV, iPad, iPhone or Roku, which is the device that Call Plus has been giving out to some of its subscribers.
So the idea that HBO is trying to adopt here is trying to cut out the middle person in the middle.
Yeah. So both services are officially US only at the moment. The HBO one that launched a little bit earlier in this year, so you can cut out your pay TV providers, the equivalents of Sky TV in the US, and you can also cut out more modern middlemen such as Netflix. So the content goes up on Apple TV, but Apple doesn't hold any of the rights. It's just the conduit to get the channel directly to you over the internet if you're willing to pay your $15 a month.
Now, the issue is it's unlikely we're going to see this in New Zealand because Sky TV recently signed a 5-year exclusive deal with HBO, so presumably they're going to be protecting that.
They will be. Sky's got most of the HBO content in Showtime, which is sort of like HBO's rival. They've got a lot of that stuff tied up as well. So it's going to be up to New Zealanders who want to access it to find backdoor channels. We actually found that when HBO launched a couple of months back, we're used to Netflix and so forth just sort of shrugging their shoulders over people accessing them from offshore, or at least the US version of Netflix. But HBO actually started to email people who'd signed up from New Zealand and saying...
Kick them off.
Yeah, proof that you're a US resident, or we'll, if we don't hear from you in a week, we'll kick you off. And they did indeed kick a whole bunch of people off.
So that's interesting that they're being really proactive in trying to police their domain effectively.
Mm. Yeah, I asked Sky TV if they'd asked them to actively encourage this, because in the past Sky has approached some providers. They said they hadn't, but they were very grateful that HBO had been a lot more assertive than some other companies that are streaming.
What about this idea that it's not one or the other, but that they can actually complement each other?
In terms of streaming and traditional TV, I actually had quite an interesting conversation with Sky last week. I was trying to glean how well Neon was going, their new streaming service, their Netflix clone, and they wouldn't reveal any numbers on that, but they did say that since Neon has launched earlier this year, that Soho has actually gained in subscribers, which is interesting. So Neon with Game of Thrones and True Detective and some of that marquee Soho/HBO content has actually served as quite an effective taster for the more expensive mainstream Sky TV service. So,
are we going to get more of these offerings potentially coming around? I mean, this seems to be a growth path in the sector at the moment.
It does, and HBO has also said that it's starting in the US, but it wants to make HBO now available in a lot more countries, and I think Showtime and others are going to follow that model, but Sky, once again, has been quite savvy, and it signed up that 5-year deal with HBO and brought up a lot of other content, so it's going to be spreading to a lot of countries, but not here, at least not in the next half decade.
Lock them in nice and tight. Yeah, indeed. All right, thanks for the update. Chris Keel with us on NBR Radio.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
NBR Radio on Wednesday the 8th of July. I'm Andrew Patterson, and with me Nathan Smith for our weekly Foreign Affairs wrap. Nathan, of course, let's start with Greece, top story at the moment. Real standoff happening here because effectively there's no deal yet on the table.
No, they're not talking, not in the way they were before Sunday anyway, but the creditors are wanting to come back to the table, so is Greece. They're not going to be able to move away from this until they come up with some sort of conclusion. But the underlying problem here is that it's not really about the debt anymore. It's almost irrelevant, in fact, especially when they're not paying any interest on this because of the rest of the European economy. They don't really have to pay this back as such, but there is still an austerity issue. But more importantly than that, there's a restructuring issue, and that was never on the table, and that's something that Germany, especially, who is the main driver of the European creditors here, doesn't really want to set a precedent for, because if Greece gets a restructuring of its debt, which it will need if it has austerity, because austerity by itself won't give Greece enough money to pay back those debts, but if they succumb to that temptation to give a restructuring of Greece's debt, then will Spain start asking the question? and then will potentially the Eastern Europe countries, when and if they get into trouble, will they start asking the same question? So there's a larger dynamic at play. It's about the European project, as it always has been. But look, Greece is. It's funny, 35% of people turned out for the referendum. Not a huge amount, but 60% of that 35% voted no for austerity, which means that there are still some people who look at the austerity measures and say, we need them in some form, some way, because the public sector in Greece is still bloated. And they've said that we're our backs against the wall here. We can't really move any further back on any of these.
Because that's the issue, isn't it? The reforms to this point have been pretty minimal.
Yeah, there's still a lot of money, especially, and they are one of the only countries that are pushing up to NATO's 2%. Defence spending, which they want, and they could pull that back as well. A lot of decisions they have to make, but the ball is not in Germany's court on this, or the ECB's court. It's still firmly in Greece's court. They need to try and figure out some other move here, but the mix on the ground is unsure. It could be a good investment opportunity, actually, in the near term. Once this happens, and there's still talk of a Greek exit as well. That would be a process over time. It wouldn't be something that just happens, and there would be some real pain for a default. But again, a precedent might be set that if Greece comes out of a Greek exit, that they leave themselves from the European Union, and then they end up doing well after they sort some things out. Not a good precedent to send anybody else. You're not supposed to be able to leave the European Union. It's not exactly like the mafia you would prefer to be in, but the point still remains. If Greece does well when they leave, then other people might be asking those questions. And of course, on the other side, there's the investment wolves at the door, so to speak. Who does Greece turn to if it was to leave? Russia is already in talks with Greece. That would put another string in Putin's bow about putting influence into Europe. China also are looking at, for them it would just be a couple, tens of billions of dollars, chump change to them, but that would also increase their amount of cachet in that part of the world as being a global power. It wouldn't look good from the European perspective. And then, of course, there's the American hedge funds. They have money looking for a safe harbour, and they might see easy investments in Greece, because Greece is a country. It doesn't disappear like an asset. It will come back, and investment opportunities could be opening up.
Yes, it's as you say, one difference between a company and a country is that you can't actually completely disappear. The other issue of a more immediate nature, I understand, is that Greece has got another payment due in a couple of weeks' time, which clearly it's going to be unable to make. And I think that's going to bring the total missed repayments to something like about $3.6 billion. Yeah,
there's a lot of money involved, but again, it comes down to how do they restructure this debt? Do they go for a default now and save the pain, or will the pain come later? Either way, the pain is coming.
All right, let's talk about China. Of course, the other story we've been following, continued gyrations in the Shanghai Composite. And in fact, my sense in the last couple of days is that there is real concern now that this is, the fixes that the government is supposed to be applying are actually spooking the market even more.
Yeah, again, to look at the underlying dynamic of what's happening there, China's trying to move to a new normal, so to speak, from low-cost exports to high-income domestic consumption, in a nutshell. To deal with that transition, they've had to sort of restructure their whole economic model. And one part of that economic model was in creation of a real estate market, commercial especially, and also a stock market, because it gives the investors, especially Chinese investors, some sort of comfortability with keeping their money in China. They want to avoid what's happening in New Zealand, Chinese money going overseas, because you can't control the yuan then. They want to make sure that people spend money in the right places, and right now that's in China. So maintain the resilience of the stock market, now that the real estate market's sort of fallen behind, is central to this. That's why the Chinese government puts a lot of money into stocks and tries to buoy them up. But that's having an alternate effect by creating what looks to be a bit of a bubble. And the Shanghai Composite Index, as you pointed out, fell 6% on July 3. That rounds it off to about 28% collapse since June 12. So there's some suggestion that the new normal transition might have stalled. That's probably premature, but there's still a lot of numbers going on in China, very, very high numbers. World Bank also came out with figures saying that 7.1% growth is expected this year, but it will drop to 6.9% in 2017. Again, not a huge amount, but that translates to a lot on the ground in China. So there's a little bit of worry.
What's also interesting, of course, is that anybody knows who's started playing the stock market. We know a lot of Chinese retail investors in there. Once you start experiencing the pain of a 30% fall for the first time, you look for the exits very, very quickly. You don't have that resilience to understand the gyrations of markets, and that obviously fuels the volatility.
Yeah, and that Beijing will be watching very closely because, again, that transition to a new normal relies on people knowing that they can earn a lot more money, which they are in China, but not save as much. They want to be buying discretionary goods, stuff that they don't need, that extra lounge suite or an iPhone. And if the retail sector's in gyrations, as you say, maybe they won't feel like that's something that they can do, and maybe the house of cards is looking a little bit shaky at the bottom.
Let's talk about ISIS, of course, also in the news, intensifying attacks across Iraq at the moment, and of course tough fighting against Iran and Kurdish forces as well.
Yeah, the Ramadan is still in play. There was always going to be a big push for them. That's what they did last year. So that's unsurprisingly. What is surprising, however, is the amount of success that some of the Kurdish forces have had against especially vehicle-borne improvised explosive devices, which ISIS have been employing across the battle space. That's actually been, they're using anti-tank missiles for that, but it's quite a pushback. And some of although it has been intensifying, the attacks have been toe-to-toe, really, and that's interesting in itself. Iran-backed Shia militias are also trying to take the initiative in that particular part of the world. But it's a bit of a stalemate. ISIS have sort of slowed down a lot, which is not good for their narrative. However, in countering that, they have opened up fronts in Egypt, especially in the Sinai Peninsula, and in the past couple of weeks across the Gulf states as well, showing that they can move. And there was a big attack against Egyptian forces in Sinai against the ISIS affiliate down there as well. So they're still trying to maintain that narrative of constant movement, constant pushing forward, but that's actually a sign of weakness. If ISIS are big in Iraq and Syria, they're having some trouble in Iraq, a little bit of trouble against the rebel forces and regime forces, and especially Kurdish forces in Syria. So they're a bit slowing down. So they've had to move elsewhere to affiliates around the region just to show that that narrative is still in play. Actually, moving to Syria, just quickly, rebel offences, regime offences, and ISIS offences have been occurring quite significantly over the past week. One of the larger ones would be in the southern parts of Syria near Damascus, which is now a city under threat. The idea being that if the rebels can push Bashar al-Assad's forces out of the southern region, he won't come back, changing the stalemate of what's going on there to an initiative led by the rebel forces. Of course, that's the area where the US backed or the US support is the greatest there. In the north, the rebel forces don't get a lot of US support. But in the north, you're also hearing rumours that Turkey might be wanting to involve themselves in this conflict, and they've moved a lot of troops to the border with Syria and have even been engaging ISIS forces with artillery and airstrikes. So it could be that they're looking to get in there.
Just finally, SpaceX, the Falcon 9 rocket exploded last week, and I guess this really does demonstrate what a tricky area SpaceX is trying to operate in.
They've got a lot of money involved with them, but a lot of money doesn't translate necessarily to expertise or experience, which are very crucial when it comes to space exploration. The Falcon 9 is one of the heaviest rockets. It's had about... I think this one and others, SpaceX have experienced about 18 successful launches over their career, so they're quite experienced here. But it does show just how difficult this is. It also shows how important it is for the private industry to be doing this. There's a lot of money potentially to be involved in a private or corporate movement into space, but geopolitically, it also brings back the dominance of the US in space. Right now, they rely on the Russians, for instance, to put all their astronauts and payloads into space. Bringing that to US soil will be critical.
Thanks for joining us, Nathan Smith, on NBR Radio.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
Market news. Pacific Edge could easily reach its target of $100 million in annual revenue quickly if only a couple of its current prospects pan out. That's according to one of the sub-underwriters of the company's recent $35 million capital raising. Pacific Edge's sales were $1.9 million in the year ended March, up from just $145,000 the previous year. Harbour Asset Management lifted its stake to 9% from 7.5% before the capital raising. Managing Director Andrew Basan says Pacific Edge updated the market extensively as part of the capital raising process, and he has also travelled to the US researching for the company. 3 of Pacific Edge's near-term prospects include its current trial with the US Veterans Association, its trial with Kaiser Permanente, the largest private health insurer in the US, and the Centers for Medicare and Medicaid Services may start using the company's non-invasive test to detect bladder cancer. Mr. Basan says all other tests have shown the Pacific Edge test to be the most effective by miles. He says the CX bladder tests achieve much better results than cytology. The outcome of these 3 prospects should be known within the next 6 to 9 months. Mr. Basan says the company has this distant target of getting to $100 million revenue. If just 2 of these occur, that $100 million, in our opinion, wouldn't be a huge step. If all 3 occurred, you would have to upgrade that $100 million target. Mr. Basan says Pacific Edge does need to deliver, but comparing the company's current value, $241 million, as its shares are trading at 64 cents, with other similar companies in the US suggests it's currently significantly undervalued. Harbour's new shares from the rights issue were priced at 61 cents each. Pacific Edge's prospects don't end there. The company has earmarked $3.8 million of its new capital to exploring its entry into the Southeast Asian market. Last month, Pacific Edge said Tan Tock Seng Hospital, one of Singapore's largest hospitals, will be trialling one of its CX bladder tests on patients. The company said it expects to work with several other leading hospitals and clinics in Singapore. Mr. Basan says the company hasn't given any revenue target for Southeast Asia, but has said the market is about half the size of the US market. He says in which case you might take a stab in the dark and there might be $50 million coming out of that market, but adds he's put no value at all on that market into his current valuation. Mr. Basan says the underwriting process and his own travels in the US have shown a number of global fund managers are becoming interested in Pacific Edge. He says people have started to do some real work on it. To climate change, the government's plan to reduce greenhouse gas emissions to 30% below 2005 levels by 2030 will leave voters believing the new target is better than it actually is, according to the Green Party. The Green Party's Global Affairs spokesman Kennedy Graham has attacked the government's plan, telling NBR Mr. Grosser is not even close to committing to a realistic climate change target. This comes after Mr. Grosser announced what he described as a more ambitious climate change target last night. The government's 2030 emissions reduction target of 30% from the 2005 levels translates to an 11% reduction on 1990 levels, according to Dr. Graham. He says the switch from 1990 to 2005 is a conscious deception, as New Zealand's emissions peaked at 2005, 6 and 7. He says all Mr. Grosser has done is take the top figures to make the target look more impressive. Dr. Graham says some 30% off 2005 is basically a form of deception because for 25 years the US has been using 1990 and the Europeans have stuck to that, and so has New Zealand. He says the 2005 benchmark is deceptive as the target is a paltry 11% reduction on 1990 levels, which is the usual benchmark for emission reductions. Dr. Graham says Intergovernmental Panel on Climate Change, or IPCC scientists, have specified a temperature threshold increase of 2 degrees to avoid dangerous climate change. He says if New Zealand were serious about this target, there would need to be a 68% reduction in the country's greenhouse gas emissions. Dr. Graham says the level the government has committed to is 57% off a level he considers sustainable for New Zealand going forward. He says if you translate the government's figures and our official projections out to 2030, if you then apply that proportionately to every other country, if they did the same as New Zealand, our global temperature increase would be somewhere around 4.3 degrees. The Labour Party's environment spokeswoman Megan Woods says Mr Gross's proposed climate change target will make National's 50% carbon emission reduction by 2050 all but impossible. She says we can set all the targets we like, but the simple fact is that this is meaningless unless we actually meet them. Meanwhile, in China, following joint climate statements by the EU and China, as well as the basic countries, China has pledged to cover 3/5 of the world's emissions. China has formally submitted its intended nationally determined contribution, or ANDC, climate change pledge, and has set a new target to reduce its carbon intensity of GDP by 60 to 65% by 2030 from 2005 levels. This extends the previous 40 to 45% cut by 2020 and represents around a 2% annual decline from now to 2030. It also reiterated its intention to peak emissions around 2030 or earlier and to increase the share of non-fossil fuel in the primary energy mix to 20% by 2030.
Wednesday, the 8th of July, Andrew Patterson on NBR Radio, and with us Mark Stafford from the TAB. Mark, just ahead of kick-off for the All Blacks against Manu Samoa, what's the betting looking like on the TAB?
Well, I guess surprising maybe to the public, but not so much to us. The Samoans really have got some supporters, especially in the head-to-head market. We opened earlier this week at $15 head-to-head on the Samoans, but 90% of the money in the head-to-head book has gone on Manu Samoa, so they've been shortened into the $8 mark. The biggest bet was $300 at 12s on Samoa to win.
Okay, there's some backing out there, but what about on the All Blacks side? I guess that's where the bigger money is.
Yeah, well, when they're $1.01, someone put $16,500 on them at $1.01 to win $165. Make what you want of that. But we have seen a lot of money from New Zealanders on the point start. Now, that's where we set what we think the point supremacy will be, and we set it at about 30 points. And we've had quite a bit of money to suggest that Samoa will stay within 30 points. One of note that I do remember was $9,000, paying $1.87, so that'll win them about $7,500 if Samoa can stay within 30 of the All Blacks.
Okay, all right. And any other tidbits of interesting gems from the betting front at the moment?
Yeah, well, the people that like, it's interesting, the people that maybe want to back Samoa but haven't got the guts to because they don't actually think they can win, we have seen money on the Samoans within the All Black team to score the first try. So Sonny Bill Williams, Kevin Mialamu and co are getting support in the All Black side to be first try scorers.
Oh, very good. That's a nice option, isn't it? That's perhaps a safer option as well too. And how does the betting compare to perhaps some of the more regular All Black games?
Well, I think the more regular All Black games are probably a closer contest. I mean, you don't see them paying $1.01 against South Africa and Australia, so you do see some money on the All Blacks. But in the head-to-head market, the All Blacks have been pretty much left alone. It's in the point starts, the winning team of margins, and the try scorers. So turnover-wise, nowhere near what we've seen for a normal All Black test. But the Samoan fans, they're putting on their $5 and $10 bets. Don't worry about that.
All right, plenty of interest. It's like a Melbourne Cup style event, perhaps with a rugby fringe to it.
Yeah, well, the Melbourne Cup's the first Tuesday in November. This is the second Wednesday in July, so let's call it the Samoan Cup, eh?
Yeah, good on you. Thanks for talking to us, Mark Stafford from the TAB with us on NBR Radio.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
NBR Radio, Wednesday the 8th of July. I'm Andrew Patterson, and with me Duncan Bridgman and Jacqueline Rowith from the University of Waikato. The untimely passing announced in the last 24 hours of Craig Norgate, the founding chief executive of Fonterra. Of course, Duncan, he had a stellar career in business, but I guess Craig Norgate will always be remembered for that initial role he took on of bringing together the co-ops to form Fonterra.
Yeah, that's right, Andrew. It's very sad, and Craig Norgate was only 50 years old. It must be remembered, and my thoughts go out to his family and friends. It's it's very sad. He had an enormous passion for the dairy industry and the agricultural sector in total, and a very visionary sort of a person, and went through a lot really, right through from Fonterra, its early days, the establishment of the co-op and through the merger, and then after that he of course went on to the rural services sector and established what is now PGG Wrightson, and he did have a plan for the meat sector as well, which unfortunately didn't work out.
Jacqueline, of course, we remember that he was only 36 at the time he was appointed as CEO at Fonterra, a brand new organisation. It was a hugely challenging task for somebody to take on. Just give us a sense of the magnitude of that task at the time.
Well, bringing in two big dairy cooperatives together and effectively having 96% at the time of the New Zealand milk supply, it was absolutely huge, and it's a testament to the man who was an accountant that he also had vision, and one's view of accountants tends to be counting numbers and being quite concerned about the minuscule and adding up the right columns. But here we have Craig Norgate leading Fonterra, and then, as Duncan has said, moving on to the other companies. Note that Taitua's executive, Paul McGilvray, is also an accountant. So people with vision, and certainly Craig had that, can do terrific good for the country. And yes, 50 far too soon.
What were his standout qualities, and what do you think it was that was part of that package, I guess, that allowed him to get Fonterra onto such a solid footing at that time of the merger of the co-ops?
Being able to do the cost-benefit analysis to actually run the numbers and show that by being a large cooperative, it would be beneficial to the New Zealand farmers and to the country as a whole. And having made that argument, I mean, he was there to smooth it through. In fact, he was there for only 2 years because the milk price fell. He was famous as being the first person in New Zealand on $1 million, and there were all sorts of questions being asked about salaries now for Fonterra, with the milk price falling again dramatically.
How do you think he would be? I don't think I saw any comment from him, recently about the current situation in Fonterra. I wonder what he would have been making of things where they sit at the moment.
Oh, well, probably feeling if he'd still been there, it wouldn't be the same. But I think really he had moved away. He'd gradually moved further and further away from New Zealand and from milk itself. And we hear that he was planning to do something in the UK. So maybe he's been saying c'est la vie.
Yeah, I think that's right, Jacqueline. I mean, he when he stepped down from Fonterra, I don't think it was totally amicable, and there was a lot of friction at the time. So, perhaps he really wanted to go on and do other things, but he would have been keeping an eye on the situation, and no doubt, would have had a few things to say about it.
And of course, in his current role, as you mentioned, Duncan, he went on to working in the rural services sector. So this was somebody who really had the agri sector very much in his blood.
Yeah, it's interesting that as we're talking now, the meat sector is still trying to come to a solution for their difficulties, and he actually sort of had something on the table back in sort of 2008, and this was after he was instrumental in building what PGG Wrightson is today, and that was through the merger of Righties and PGG and Williams and Kettle. And then he wanted to take over what was PPCS, and that's the Silver Fern Farms as it is now. And it was a grand plan, and I think had the support of the industry. Unfortunately, his timing was bad, and the global financial crisis struck, and the mountain of debt that was in that kind of entity brought it down. So, and it had to be put on ice.
Jacqueline, you mentioned, of course, his skills as an accountant. Of course, he went on more recently to working with the Institute in terms of, I guess, trying to bring a fresh face to that organisation. What do you think were his successful qualities, as you've mentioned, in terms of this ability to merge a strong accounting analytical mind with a sense of vision as well?
I think you summed it up very well, and there are a few people who can actually do that. But to be able to sell to people the stories of the benefits was a great strength. And there are people who can do the merging part and then move on to do another one, because that's their challenge and that's what they really get benefits from personally, is seeing a stronger institution that they've brought together. And then running it, well, they like to move on to a new challenge.
Yeah, that's a good point, Duncan. That did strike me about Craig Norgate. He was the sort of person who loved to be there at the start, making things happen, and then once it got to a certain point, he wanted to go on and create a new challenge for himself. He was always the sort of person that wanted to be part of inventing the new wheel, effectively.
Yeah, you could say he's sort of restless in that respect, but he's incredibly bright, as I understand it, and I probably spoke to him, a few times during the sort of mid to late 2000s, and we got on pretty well. I must say he's a very likeable chap, and this is a
larger
thing.
Than life.
Yeah, this is the thing. I mean, after that, or during the GFC, and after that, and there were some enormous losses that shareholders had to bear, and I guess he's largely at the top of that, and you could say responsible, but. I mean, not many people had a bad thing to say about him. I mean, he was still respected and everything. Everyone sort of liked him.
Even though he could be tough, Jacqueline, I understand he was a pretty fearsome negotiator as well.
Well, yes, you have to be when you're bringing in two big organisations, or even three in the case of the Wrightson deal. So it's always going back to be able to explain the benefits. So cost-benefit analysis, show them the bottom line, talk about the influence, sell the story, and he managed that on several occasions.
NBR's Duncan Bridgman and Jacqueline Rowath from the University of Waikato reflecting there on the untimely passing of Craig Norgate on NBR Radio.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. Underwriter says Pacific Edge could reach target sooner. Analysts lift Somerset ratings. A surplus could be on the way. Milk powder futures predict another slide. And Mega looks set to go into list mode. To find out more on our stories, just log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. And you could even stream them in your car on the way home. Media news. Radio New Zealand has confirmed presenter Simon Mersep is leaving the public broadcaster. He will sign off for the last time this Friday, having hosted the afternoon's programme since last year. Prior to Afternoons, which is broadcast 1 till 4 weekdays, Mr Mersep was co-host on Morning Report for 3 years and the first to permanently present the show from Auckland. His shift to the later show was part of a shake-up of presenters that saw him and retiring Morning Report co-host Jeff Robinson, who had presided over the programme for 35 years, being replaced by Guyan Espiner and Susie Ferguson. Although Mr Mersep got his start in journalism as a trainee reporter at RNZ, his broadcast career has included stints with One News, Homes and Fair Go. The departure of Mr Mersep, who RNZ Chief Executive Paul Thompson has described as a highly valued and well-liked broadcaster, has inevitably prompted speculation about who might replace him in the slot. Various media commentators have picked John Campbell as a natural fit for the public broadcaster, but the pundits at NBR Towers believe he would be wasted in the gentle chat-driven afternoon slot unless RNZ management is seeking a sharp shift in tone. Other possibilities floated include Jesse Mulligan and Noelle McCarthy, both of whom have filled in for Mr Mersep on the afternoon show. One of NBR's self-appointed experts is adamant the best replacement is Jim Mora, who was himself replaced by Mr Mersep as afternoon's host in April 2014. Mr Mora was moved into a co-host role on Checkpoint between 5 and 7 p.m, but his avuncular interview style is widely regarded as a mismatch with the take-no-prisoners approach of Scary Mary Wilson. It's also understood the program has taken a ratings hit in Radio New Zealand's latest rolling survey. Besides, Mr Mora is still arguably hosting a quarter of afternoons in any case, having retained hosting duties for the panel, previously an afternoon segment. It runs from 4 till 5. To Christchurch. Christchurch ratepayers may provide most of rates supporting Environment Canterbury, but they'll be permitted just 4 representatives out of 13. Environment Minister Nick Smith and Associate Local Government Minister Louise Upston have announced the new structure of Environment Canterbury. The national government sacked elected councillors in 2010 and installed its own managers to advance water projects for the rural sector. In October 2016, the government will appoint 6 commissioners and allow 7 elected councillors. During the consultation phase, there were 534 submissions received, the majority of which were opposed to a mixed model and supported full democracy. Mr Smith claims 475 of the submissions were organised by the Labour Party. The rural council mayors who were behind the axing of elected members in 2010 supported the mixed model. Irrigation New Zealand, Fed Farmers, Trustpower, Genesis and Ngāi Tahu were in favour of the half-democratic model. Mr Smith's media release provided much praise for the appointed commissioners led by Dame Margaret Baisley, claiming enormous strides in water management. The existing commissioners will be offered jobs. There was no information about the pay elected members will receive. Dame Margaret Baisley has received $220,000 a year salary, and the other commissioners' sums of more than $100,000 depending on duties. This compares with the $50,000 odd for the previous elected chairman.
NBR Radio, Wednesday the 8th of July. I'm Andrew Patterson. With me, Cullida Smiley. Cullida, a new crowdfunding site announced, and it looks like this space is actually starting to look very crowded itself.
Yes, so Liftoff got its licence a few weeks ago. It's the fifth crowdfunding platform to get a licence from the FMA. They haven't got any companies yet on its site, and when I was talking to the director, Bruce Shepherd, who's founded the Shareholders Association and an accountancy firm, he said that they want to be a bit different. They don't want to crowd their platform. There's going to be a ecotourism venture that will launch sometime this month, and it's got local iwi connections as well.
I understand the FMA has still a number of other applications in the pipeline to be decided for more crowdfunding sites.
That's right, and I've actually just asked the FMA to confirm who's applied and whether these will get granted or not. And I guess it's just up to people to decide which crowdfunding sites work for them. They'll probably be able to judge the offers coming out of them and make up their minds whether they're quality or not.
Bruce Shepherd, of course, never one to hold back on his views. I understand has some fairly strong views about the way some of the current crowdfunding sites have been valuing new companies. What did he have to say in that regard?
Yeah, he was pretty strongly worded on this. He thinks that some of the valuations coming out are far too high and the forecasts are too wild. He says that his crowdfunding site will have valuations on them that wholesale investors would approve, and just not promising the world on these things. Did
it indicate how their approach will be that's different from the others in terms of their valuation metrics and the way they go about that process?
I think he just alluded that they've got a lot of experience doing this. He said they weren't bankers, or perhaps one of the directors is a banker, but he said they've got an experienced board and they'll be letting companies come to them, pitching their ideas and their valuations, and then they'll assess them. And to an extent, the other crowdfunding sites do that as well.
Did they indicate if they're going to focus on a particular type of company? You mentioned some of those with perhaps iwi connections and so forth. Is that an area that they want to specialise in?
Yes, I do think so. On their website, they've got that they will be supporting Maori business ideas. One of the directors, Andrew French, is a Ngāti Apa Developments Director, so he's got a lot of iwi connections as well. But I did ask Bruce what sort of companies they'll focus on, and he says a wide range. They've got a couple of software as a service companies that they're lining in the pipeline, and but he says that they won't be focusing, on these little startup technology companies so much that, might have very high valuations put on them.
More broadly, obviously he's supportive of this approach given the decision to start the new company. How does he assess that crowdfunding has actually changed the landscape within New Zealand?
Yes, he obviously very supportive of equity crowdfunding and what it can do for young companies trying to raise capital. But he said that in the past it was only venture capitalists or high net worth investors who've been able to invest in these opportunities, and he says it really levels the playing field for sort of more normal investors with a lot less money to get into these opportunities that may provide quite a lot of returns in future, although 4 out of 10 companies at least fail in the startup space.
I was interested in a quote that he gave you. He says, "I'm happy that crowdfunding came to New Zealand, but what I saw fairly early on was it was actually being treated as an opportunity to misprice risk, and I want to level that playing field." So clearly he's going to come at it from a very different approach, as we've spoken about.
Yeah, I think that just comes back to the valuations. He and his other directors think that the valuations have been too high in this space, and they want to bring them down and offer more realistic opportunities to people.
Is there going to be enough players in this market to make all of these sites viable? I mean, given the market is pretty small in New Zealand, you wonder how all of these sites are going to be able to make money over time.
And some of them won't. Invariably, some of them will collapse. PledgeMe just released their figures for the financial year because they did a crowdfund for themselves, and they'd missed their targets already.
So this could be a volatile series of platforms managing a very volatile number of new listings as well. So we follow it with interest. Thanks for joining us. Calida Smiley there with us on NBR Radio.
NBR. Need to hire? Try our online recruitment platform, www.nbrtalent.co.nz.
NBR Radio, Wednesday the 8th of July, and with me, Rob Hosking. Rob, the government getting some good news finally from Finance Minister Bill English. The numbers for that in terms of where the government accounts sit at the moment actually looking reasonably promising.
Well, they are. We had the latest monthly update of the Crown accounts, which and this takes us to the 11th month of the financial year, so there's only 1 month to go. And they're starting to look as if they might get a surplus after all, despite having sort of written off their chances pretty much. We've still got a month to go, and also at the end of the year, there's all the various reevaluations, and a number of things get washed up in that, and that's some of those numbers can move quite dramatically, so we shouldn't sort of bank the surplus yet, as it were. There's some big numbers that can shift around, particularly something like the New Zealand Superannuation Fund, which has billions, and they can change the way they invest, and that can, when that gets sort of ruled the line under at the end of the year, that can shift things. But it is 1.1 billion surplus at the moment. Project on today's figures, you've got a company tax up 350 million, I think, ahead of forecasts. That's not insignificant. That was the biggest change. That was most of the increase, actually. The other thing was the what they call other individuals, which is basically taxation of returns on investments, and some of that's just people who have invested in equities, particularly offshore, I suspect. Given the equity boom that we've seen in some parts of the world in the last year, some of that's starting to flow through. It certainly isn't extra income from your term deposits because interest rates have gone down. But yeah, this is starting to look like for the financial year that finished last week or 10 days ago, this is looking a little bit better.
Crown accounts also showing that the ACC insurance liability a little bit less than forecast as well. So the numbers are moving through to the right side of the ledger for the government, and they'll be keeping fingers crossed that will continue.
Well, I think they'd probably quite like to surprise on the upside, to use a bit of economic jargon. I think one of the things they have to watch for here is, not watch for, because the margins we're talking, even though, to you and me, a billion here, a billion here, it's big numbers. The fact is these things can move around quite dramatically. In fiscal terms, they're pretty small numbers, and it doesn't take much to throw them out. And we could get the slightly awkward position where we get a surplus this year, and then go back into deficit next year, particularly if the economy slows the way it is now starting to look like it is slowing. And we do know that, we're not going into negative territory by any means, but we do have an economy which 6 weeks ago people were talking about 3% GDP, not only for the current financial year, but for the next couple of years. And I think, you'd be scratching to find an economist who thinks that's going to happen now.
Yeah, it struck me today when we think that it was only 6 weeks ago since the budget. A lot seems to have changed, both in terms of, as we know, that the macro global situation, but also sentiment locally. And I see that was reflected in the latest Institute of Economic Research quarterly survey of business opinion as well.
Yeah, and that was. I mean, I thought the NZIR survey would drop more than it did. It's some aspects of it are the economy holding up very well. Building and construction's barely come off at all, and there was expected to be some fall off from Christchurch there, just because the Christchurch rebuild is still very much going on. We shouldn't forget that, but it's coming off its peak. Retail actually took quite a hit, but some other areas are performing reasonably well, and I think. That fall in business optimism, yes, it's significant. It's still consistent with GDP growth of around 2.5%. It's just not sort of 3.3% anymore. The other thing which I do put quite a bit of store on is firms are also asked, their investment and hiring intentions, and both those are still running really quite strong.
Now, in your opinion piece published today, you talk about Labour and the Greens needing to stop poor-mouthing the economy. This is the risk at this point, isn't it, that we can actually talk ourselves into a recession?
We can, and it's or even if it's not talking to a recession, certainly talking ourselves into underperforming. And the economic self-talk, if I can borrow a phrase from therapy speak, is quite significant. We're talking about dropping in economic gear here. We're not talking about going backwards. And there was a bit of talk, mostly based on a misinterpretation of bank economist, the ANZ Bank chief economist Cameron Baggery, who suggested, well, maybe if things do look like slowing, maybe the government brings forward some of its fiscal, what the technicians call fiscal stimulus. And in this particular case, the tax cuts, which the government's got planned for 2017, bring them forward a year, and maybe provide a bit of rates relief if local bodies can do that. But he wasn't even necessarily talking about easing fiscal policy. It was more moving it to a bit more neutral. Where at the moment, fiscal policy is the government's tax and spending policy, and the effect that has on the overall economy is slightly contractionary, and that means it's leaning against inflationary. It's stopping the current expansion, and we have been expanding. Let's not forget that, getting out of control and overheating into inflation. Now we do know, of course, that inflation is pretty minimal right now, and that too could change if the currency keeps heading downwards, because we'll start importing inflation. Cost of imports will go up. There's been a big overreaction around this, and I think what I think opposition parties need to do is, you can come up with policy and, a program, if you like, which doesn't involve saying the economy is going into the toilet. You had Andrew Little saying we were facing a perfect storm economy, which is just nonsense. You've got the Greens sort of saying, we need to stimulate the economy by building more railways. And, there's been a real overreaction to what was actually a fairly neutral comment by one bank economist. Cameron Baggery's comments have were seized on by Labour in particular as being basically saying the government needs to start spending more, and that's just not what Baggery was saying. It certainly isn't what any reputable economist would be saying right now.
And it's not consistent with the approach that this government has taken to its economic management, certainly not under Bill English, where you just throw money at a problem and think that the money is going to solve it.
Well, no, and I think what if you are going to invest more, then you need to be a bit careful about what it is and make sure you're getting it's not enough to just say, let's stimulate the economy by spending more on infrastructure projects. You need to actually be sure that you're getting a damn good return for that capital investment. And building an extra railway or two, I don't think is going to actually do that. Rob
Hosking joining us on NBR Radio.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
In dairy news, the price for New Zealand's key dairy export whole milk powder may drop further in next week's GDT auction as dairy farms boost production amid a global glut in milk supply. The current July whole milk powder futures contract last traded on the NZX at US $1,910 a tonne. Because the price is an average of 2 fortnightly auctions and the contract was priced at $2,000 a tonne. In last week's auction, traders see a decline of 10% to US $1,800 a tonne next week. The longer-dated whole milk powder futures contracts are all trading at a discount to the GDT, suggesting traders expect prices to fall. Dairy prices have remained lower for longer amid higher global supplies in New Zealand, Europe and the US, weak demand in China and an import ban in Russia. New Zealand production is rising, heading into the country's peak supply period in October, while US farmers are reportedly dumping milk and the EU has ended its quota limits. OMF Financial Markets Director Nigel Brunel said it's pretty negative. There's a lot of selling in the futures and there's not much buying. This market looks completely stuffed. Whole milk is looking to be down another thumper, and then it gets worse because the volume starts to step up again as we get into August. There is just a gap between what's being produced and what is being consumed. Weaker dairy prices are weighing on New Zealand's economy, cited as a reason for decade-low rural confidence levels, deteriorating business confidence, and are firmly on the radar of the Reserve Bank, which has begun cutting interest rates to bolster slowing growth. Mr. Brunel said it's going to put more pressure on the Reserve Bank to ease. Traders are pricing in a 96% chance the Reserve Bank will cut the benchmark interest rate at this month's meeting, according to the overnight index swap curve. Some economists are forecasting 3 further interest rate cuts this year, which would fully reverse the central bank's tightening in policy last year when it raised interest rates by a percentage point. The New Zealand dollar touched a fresh 5-year low of 66.19 US overnight, with traders citing the impact of weaker commodity prices. Mr. Brunel said the Kiwi is under pressure. It has a real trickle-down effect on other parts of the economy. Weak dairy prices have prompted analysts to pull back their expectations for Fonterra's payout to farmers this season, with most forecasts now sitting below the dairy exporter's $5.25 per kilogram of milk solids. Market expectations range between $4.50 and $5.40. In People News, Craig Norgate, the inaugural chief executive of Fonterra when it was formed from the merger of Kiwi Co-op Dairies, New Zealand Co-op Dairy Company and the New Zealand Dairy Board, has died in London. He was 50 years old. His son, Jordan Norgate, who lives in London, told media, "My mother Jane, sister Alexandria and brother Dylan and I loved him very much. He had a heart of gold and he will be dearly missed." Fonterra's official social media account posted at 9:11 last night New Zealand time says, "Sad to hear of passing of Craig Norgate, our first CEO, who cared passionately about dairy and New Zealand agriculture. Our thoughts are with his family." NBR columnist Matthew Hooton, a former head of communications for Fonterra, worked with Mr. Norgate on the dairy industry mega-merger in the first year of Fonterra. Mr. Hooton says he was the brightest person you'll ever meet, way off the chart, both in terms of being intellectually smart and also street smart. His vision was for Fonterra to be a nimble, fleet-footed, fast-moving international company led by a small corporate centre of just 50 people. Sadly, we can only imagine how much better off dairy farmers and New Zealand would be had he been allowed to execute that, rather than see Fonterra become the lumbering monolith it defaulted to after the board decided it wanted less aggressive leadership. Mr. Norgate ran New Zealand's biggest dairy company for 2 years and then teamed up with the McConnon family to form Rural Portfolio Investments, which acquired a controlling stake in rural services group Wrightson, merging it with Pinegold Guinness in 2005 to form PGG Wrightson. He was instrumental in the creation of New Zealand Farming Systems Uruguay, which aimed to repeat Fonterra's success by developing dairy farms in South America using New Zealand farming techniques. His grand vision faltered in 2008 when Wrightson was caught by the credit squeeze from the GFC in 2008 and was unable to settle an unconditional offer to buy a half stake in Silver Fern Farms for $220 million. Most recently, he had responsibility for overseeing the merger of Chartered Accountants Australia with its New Zealand counterpart. He didn't front for the current lawsuit taken against the accounting body by rival CPA Australia. Mr. Norgate was also a director of the New Zealand Rugby Football Union from 2000 to 2002, on the Taranaki Rugby Football Union, and a director and investor in the Chiefs, 2013 until, of course, his death. Just a month ago, he wrote an open letter for the Taranaki Daily News titled "The Chiefs Belong in Taranaki." He's survived by his wife, 2 sons and a daughter. Let's talk China and our economy. As China's markets plunge into bear territory and consumer sentiment takes a dive, New Zealand's economy faces backwash in the short term. ANZ senior FX strategist Sam Tuck says the continued decline in the Chinese stock market remains a concern for New Zealand's economy. In the space of a month, the Chinese stock market fell off a cliff into bear territory. The Shanghai Composite, the country's main stock exchange, fell 1.3% on Tuesday, putting it down 27.9% from its peak in mid-June. Until then, the market was booming. Mr. Tuck says even if stock markets are coming off very elevated levels, a crash, particularly one which is influenced by margin traders or borrowed money losses, has a rather large impact on sentiment and consumer activity. He says consumer activity tends to go up when the markets are doing well and consumption rises, but this has a short half-life. When the markets enter a bearish territory, as has happened in China, it dampens consumer sentiment and depresses consumption. Mr. Tuck says this has a relatively long half-life. People remember the losses more keenly than the gains. A sharp decline in the Chinese stock market, regardless of the highs it's come down from, is a worrying sign for China, as it's been looking to rebalance manufacturing-led GDP growth to internal consumption-led GDP growth. Mr. Tuck says this is important for New Zealand's economy, as clearly an absence of Chinese demand for commodities such as dairy would not be good for the economy. Added to this is the important role Chinese tourists have in New Zealand's economy, being the second highest source of tourists to the country. Mr. Tuck says the sentiment of the Chinese consumer is vitally important for the short-term prospects of New Zealand's economy. But he says in the long term, the downturn in China's stock market won't be too damaging to New Zealand. China has growing demand for New Zealand products, so a short-term dip in consumer sentiment won't be too detrimental in the long term. Mr. Tuck says Chinese demand for New Zealand goods and services is so impossibly high we don't actually need to worry about the total level of demand, as we already can't keep up with it.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Wednesday, the 8th of July, NBR Radio. The Paris Conference on Climate Change at the end of this year is shaping up as a triumph for world diplomacy. In his editor's insight today, Neville Gibson warns that while expectations may not be high, the result could be surprisingly good. Neville, why are you optimistic when previous climate conferences have actually failed pretty spectacularly?
Well, I think the main reason is going to be that realism and pragmatism will win over zealotry and ideology, and we've had too much of that. For too long, the climate change debate, in my view, has been dominated by doomsday merchants and everyone from scientists to environmentalists. But for a variety of reasons and motivations, these people say the world's doomed from rising temperatures and they want to blame Western civilization. And at the more extreme end, they want to tax people out of most forms of transport, heating, power generation and the like. And they want the Western world to retreat from our high living standards and condemn, I presume, the rest of it to not rise much above where they are now. In some cases that means, of course, abject poverty, and that's not really a viable position for any government. So if you have that kind of view driving a conference, it's not going to succeed. But the most interesting thing about the Paris conference is that those issues are going to be put to one side.
So what do you think the likely outcome is going to be from Paris?
Well, it's pretty obvious at this stage that there's going to be an inclusive type document to which all the nations can subscribe according to their ability. And the reason they will be able to buy into it is that it's not going to be sort of one of those all-encompassing controlling ones like we've had in the past. Because back in 1987 there was the Montreal Protocol, which was a good one because it had a focus on reducing and eliminating what are they called, CFCs, the dangerous gases that were in refrigerators. I've forgotten the actual name for it, because it was damaging the ozone layer. People bought into that because they could see it was a limited problem and getting out of them was relatively painless. Climate pollutants, if that's the right word, they're different. They're everywhere. They're a byproduct of our modern way of life, and they're also not just limited to carbon dioxide and so on. They also contain methane and recognisable pollutants like soot and nitrous oxides. All of these contribute to rising temperatures. In New Zealand, for example, methane gas largely comes from livestock. The only solution, if you want to eliminate methane, is to kill all the livestock. That doesn't make sense, and nor does it make any sense to have a big single global tax and regulatory system that doesn't apply to all.
The issue in the past, though, has been arriving at a specific consensus. So how do you believe a consensus can be reached this time around?
Well, there's already a consensus of sort, and that was the G7, the big nations, and the United States and China have agreed, and most people have bought into that we need to keep the changing global temperatures to about 2 degrees from pre-industrial levels, and that's going back to the 19th century. This is the kind of goal that people say, okay, if that's the sort of overall thing, this is how we can get there. Now, one of the reasons I think that we're getting to a more realistic level for these conferences is that the public opinion has finally been persuaded that this indeed is a good goal, because in some ways they can link pollution, which really affects them, the environment, and recognisable pollution, can be linked to greenhouse gas emissions. And we also know that there's a lot of technology being developed or is possible in the future that will reduce them, so that we can move to, say, all electric cars, depend on solar power rather than coal. So all these nations have come and said, well, we can do this. The rich nations are already halfway there, if not achieving them. They've set quite high goals for themselves. And the poor nations, well, they say, well, there's a bit of a problem here with finance and investment. The conference is going to come up with some solutions for that.
How will these reductions, do you believe, become binding?
Well, they won't become binding in the sense that you're going to be punished, but they are targets, and they'll be controlled in many ways by countries' own opinions of themselves or what their populations want. And it's good that both China, representing one form of industrialisation, and the United States are leading the pack. And obviously these are countries that can invest a lot in solar capacity. They can invest in nuclear power for those countries that want it. Even Germany and Japan, where they're less keen on nuclear power than they were, they are very heavily dependent on coal, but they're saying they're going to move away from coal. So that's how I think countries are going to be bound by their own promises and pledges.
What do you believe will be New Zealand's role and stance at this conference?
Well, I personally won't be there or anything like that, but at the recent Otago Foreign Policy School, our climate change negotiator, Adrian Massey, who's now at Victoria University, gave a very good outline of how New Zealand conducts its global climate change diplomacy. And he said, well, we've got specific issues like the livestock animals, and the targets we set are actually quite modest, but they're achievable. We've got a lot of power generation that's almost all renewable, that sort of thing, leaving just transportation. But he says the emission trading system that we were the first country to buy into because we included everything in it has been a complete failure, mainly because there's no realistic price for carbon. So he says that's all got to be looked at again, come up with better solutions. But he says the most important outcome in Paris will be that countries can make realistic agreements and goals and that sort of thing, and that'll be subject to constant review, probably about every 5 years or so, so that the technology can be matched to the achievement of those goals. So I think that he's given a very sensible outline of what could happen, and one hopes that that will.
Do you also believe that there is a greater sense of urgency now? Just in the last couple of years, we are beginning to get some really compelling evidence, if you buy into that, but also just a greater degree of consensus that the world does have to begin to address this problem.
Yeah, I think the previous climate change conferences have been stuck on a whole lot of IPCC figures and scientists arguing over this, that and the other. But this goal of reducing 2 degrees, people can sort of understand that. We must keep it down, and it's then just a matter of practical solutions to reducing carbon emissions and moving from certain types of energy we do now to others. And the main benefit is that we become more efficient at using power, resources aren't waste, pollution is reduced, and people's standard of living can go up.
Appreciate your insights. Neville Gibson with us on NBR Radio.
NBR Radio with Hotel de Brett, partying since 1959. www.hoteldebret.com. NBR Radio.
To the markets, NZX, which is New Zealand's only registered stock market operator, strongly opposes a bid by share trading platform Unlisted to be exempted from new licensing requirements, saying its lack of basic shareholder protections could tarnish the reputation of the country's capital markets. Unlisted is petitioning Commerce Minister Paul Goldsmith for an exemption from being licensed by the FMA as required by the Financial Markets Conduct Act, which came into force in December, arguing it offers a lower-cost alternative for smaller companies than NZX. However, NZX rejects Unlisted's bid for an exemption, saying the new law is an opportunity to reconsider whether Unlisted should continue operating outside of the regulatory framework. The Wellington-based company says in a submission to the Ministry of Business, Innovation and Employment, NZX considers that the granting of such an exemption would result in significant and unnecessary risks to the confidence, integrity and reputation of New Zealand's capital markets. The Financial Markets Conduct Act arose out of the Capital Markets Development Task Force in 2009, which looked to deepen New Zealand's capital markets while beefing up investor protection and regulatory oversight after the collapse of finance companies. The legislation overhauled the country's decades-old securities law with a goal of improving public confidence in New Zealand's capital markets. NZX said a broad exemption would be inconsistent with the policy rationale underpinning the entire new act and outlined its concerns regarding insider trading, market manipulation and the lack of other rules around disclosures and regulations. It said the lack of disclosure and market supervision for Unlisted meant it was effectively impossible to highlight cases of insider dealing or market manipulation. NZX said the FMCA outlines basic shareholder protections in relation to the operation of fair, orderly and transparent public markets, including prohibitions against insider dealing and market manipulation. The lack of these basic shareholder protections is arguably tacit acceptance of the type of market misconduct which has the potential to tarnish the reputation of New Zealand's capital markets. It said this is an extremely undesirable outcome given that market confidence is still fragile following the GFC and recent finance company collapses, adding there was no justification for overriding well-considered policies so soon after implementation of the new law. And for more on this, nbr.co.nz. In market news, Mega has updated its company constitution, making it easier for the file storage and encryption firm, which has more than 18 million registered users, to list after a failed attempt to join the NZX through a backdoor listing earlier this year. The company filed a new constitution to the Companies Office on July 6, which added specific provisions for listing the company, stating that the board shall take all reasonable steps to prepare the company for listing on a recognised stock exchange, and setting share sale restrictions for a maximum 12 months from the date of joining a bourse, unless the board determined otherwise. Mega Chief Executive Graham Gaillard said the new constitution would make it easier for the company to list, but declined to comment on the time frame for going public. The company's website is already geared up to provide shareholder updates, with a page devoted to shareholder reports when Mega becomes a publicly held company registered on a recognised stock exchange. In May, the Auckland-based company aborted plans to list on the NZX via shell company TRS Investments after a series of delays in gaining approval to go ahead with the deal. The transaction would have seen TRS acquire Mega for $210 million by issuing 700 million shares at 30 cents apiece to Mega shareholders once a share consolidation was completed. Mega shareholders would then have owned 99% of TRS, which would have changed its name to Mega. The Constitution also adds new provisions for the board to issue shares, including pro rata issues to shareholders, small issues of up to 15% of Mega's stock in a 12-month period, and an employee share scheme not exceeding 6% of shares on issue at a price that's the greater of either the immediately prior issue or giving Mega a pre-money valuation of $95 million. Mega was launched by internet entrepreneur Ken.com in 2013 to replace his mega upload empire, which was frozen after his high-profile arrest at the behest of the US federal government. He since stepped back from the firm to fight his extradition and to bankroll the Internet Party, which failed to gain seats in Parliament at last year's election. The company has 16 registered shareholders, of which director Shen Xiao Wu is the biggest investor with almost 26% of Mega. Mr. Shen is a regular donor to the National Party through his Conchu Jinwan Enterprise Group and increased his stake in Mega in a share issue amounting to 6.7% of the company in February. The next biggest shareholding of about 16%, held through Tay Trustee Limited, is frozen by a restraining order over the assets of Auckland businessman William Yan. Wolf Ortman is the next biggest shareholder with 15.6%, followed by .com's estranged wife Mona via Coatesville Trustee Services with 15.5%. Earlier this year, PayPal stopped processing payments for Mega after NetNames, a US group with funding from the Motion Pictures Association of America, claimed it was among companies whose services were not legitimate or legally compliant. Mega rebutted the claims with a legal opinion by international law firm Olswang, which found no evidence that the bulk files stored by Mega infringe on copyright holders. The firm's target audience is different from typical CyberLocker users, as its services wouldn't benefit them, that the platform isn't attractive for mass distribution, and that its business model is different from CyberLocker's. The company is expanding its product offering to include encrypted audio and video calling, now in beta mode. Let's talk crowdfunding. A new equity crowdfunding platform has been granted a license, and its directors say it will do things differently with lower company valuations. Liftoff was granted a license by the FMA about 3 weeks ago and has not yet launched a campaign. Director Bruce Shepherd, who founded the Shareholders Association and accountancy firm Gilligan Shepherd, says most crowdfunders pump an offer out as soon as they launch, but we want to be a bit more circumspect than that because we want to be different. Fundamentally, he says, we want the value equation to be loaded to the buyer, not the seller, which means we turn stuff away. We don't clutter the platform, and we don't want to run a warehouse store. The first offer, which will launch this month, is an eco-tourism venture with local iwi partners. Mr. Shepherd, who would not yet name the company, says it's not software, it's none of these quirky projects where you can hoodwink the public with high valuations. It's a bricks and mortar business. Mr. Shepherd and his fellow directors, former New Zealand Trade Commissioner and Ngāti Apa Developments Director Andrew French, former FMA Strategic Intelligence Head Adam Hunt and former HSBC Bank New Zealand Treasurer Tim Fitzgerald believe equity crowdfunding gives investors access to opportunities previously only available to high net worth investors or venture capitalists. But they're also concerned some offers coming out of other crowdfunding sites are being valued too highly. Mr. Shepherd says, I've always been in wholesale markets with private equity and venture capital. I've bought enough of those sorts of businesses at prices between 1 to 3 million that have superior revenue profiles to what is being sold on crowdfunding platforms to actually know that this stuff is grossly priced. Overpaying for a company to start with raises the risk profile of an investment, affecting returns and putting investors more at risk when shares are diluted due to further capital raises. Liftoff was set up to move valuations to sensible areas and will take a practical approach based on what prudent wholesale investors might pay, according to Mr. Shepherd. He says, I'm happy that crowdfunding came to New Zealand, but what I saw fairly early on was it was actually being treated as an opportunity to misprice risk, and I want to level that playing field. The core issue, he says, is to identify and make value available to the public. Value is a transparent risk for a fair price. Like other crowdfunding sites, Liftoff's board will run due diligence checks on offers. Mr. Shepherd says Liftoff will not have permanent staff or offices, which will keep costs down.
NBR Radio. Free to air online with business news you can use.